Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, June 9th, 2021, and I'm pre-recording this Trading Places Live for Thursday, June 10th. Futures currently are pointing a little bit higher. At last check, NASDAQ futures up about 17 points. The S&P 500 futures up about 5.25, and Dow futures up about 40, all roughly up about 0.1%, maybe slightly higher. But the S&P 500 is the one I'm watching closest, trying to see if we can get this breakout above the 42.3260 level. We have not had a close above it. We've been tracking that level here the past few days, but really unable to try to get that breakout. And so if we can get that breakout, that would be really bullish for the market, especially with inflationary reports coming out here over the next couple of days. I think we're going to see a pretty high headline number on Thursday. And the market, in my opinion, has actually been performing pretty well. So we'll have to kind of keep an eye on that and see how things progress throughout the morning on Thursday. Before we get into the action, let's go through the agenda for today. Start off with the daily market recap, as we always do. Get into talking technically. I've got a few ratios I'm going to show you. I think these are ratios that I would keep an eye on just to really gauge the sustainability of the recent market advance. Then we're going to get into break it down. I want to take a look at the healthcare sector. This is a group that historically does pretty well during June, and it's gotten off to a good start. So I think we got some good information for you there. Then we'll get into earnings spotlight, a couple of key earnings reports out after the bell, and then we'll wrap up with the three you must see. Before we get into any of that, I do want to point you over to earningsbeats.com. We are running our spring special. If you go to earningsbeats.com, you can click on the link there, and this will give you a really good idea of what we have to offer. The spring special runs for, well, the deal is an annual deal. So if you go through and you take a look at the monthly membership, which is $147 a month, makes a whole lot more sense if you really like our service to consider the annual membership, which is $997 for the year. And that includes 2 bonus months. So for 14 months, which based on the regular monthly rate would charge $2,058, you actually save 52% going with the annual rate of $997. So it certainly encourage you to check that out. Also want to mention that if you are looking at Earnings Beats, you go to our homepage and scroll down. There's an Earnings Beats Digest newsletter. This is a free newsletter. All you have to do is type in your name, email address, hit that subscribe button. We'd love to have you join us. It is a free newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays. No credit card required, and you may unsubscribe at any time. All right, taking a look at the action, moving into the daily market recap. Really, the action that we saw on Wednesday was very similar to what we've seen the last couple of days. We've really just struggled to try and get through key resistance. The Dow Jones actually was down about 153 points on Wednesday, falling more than 0.4%. The S&P 500, 42.3260. That's the closing breakout level. We were above that intraday again today. Could not sustain it into the close. We closed at 42.1955, well below that breakout level. So we'll see what happens on Thursday. But at this point, I would say the market is at least set up for failure at this key resistance level. So let's keep watching that level. NASDAQ was down 13 points on a relative basis. The NASDAQ's been outperforming here this week, which for me personally, I'm a little confused about how the NASDAQ is trading right now, because if you think about it, in a inflationary environment, growth stocks should underperform. That's history. That's just how the market tends to work. Those future earnings are not nearly as valuable in an inflationary period. And as a result, the NASDAQ tends to underperform. But here we are going into a really key inflationary report, and the NASDAQ is actually performing better than the S&P 500, and we are getting close to a high. Um, I think the headline news is going to be a little bit scary and maybe even a little bit bearish, but I would pay much more attention to what's going on in the charts and stay away from necessarily those scary headlines. NASDAQ down 13 points on Wednesday, but it has been in a nice uptrend for really the last month or so. We were down at about 13,000. This was just 1 month ago. Now we're up near 14,000. So a really good move here in the NASDAQ shares in just the past 30 days or so. Mid caps down 18 points, or about 2/3 of 1%. Small caps down closer to 1%, almost 9/10 of 1%, dropping 12 points on Wednesday. But overall, I would say that the small caps continue to be the best performing area of the market. And as long as we stay above that rising 20-day moving average, I would be okay with those small caps. Looking at the sectors, healthcare, and we're going to talk about healthcare in just a couple minutes, but healthcare up almost 1% on Wednesday, finishing at a 123.33. Recently, after testing that 20-day moving average, or excuse me, 50-day moving average at about 121 or so, we've bounced nicely off of that. And I think we're going to make a run up here for this 125, 126 area. Utilities continuing to move sideways. We had a strong day on Wednesday, but overall, we remain range bound within the utility space. Industrials pulling back, testing that 20-day moving average, closing at 103.81, which was just beneath the 20-day EMA at 104.10. We'll see whether or not we can bounce back above it tomorrow with the inflation data that will be out. Financials really struggling. The 10-year Treasury yield, I'm going to go over this in just a minute, but the 10-year Treasury yield struggling of late, moving below 1.50%. And I think that is having a very negative impact on the financials in the short term. We have higher prices, we have lower PPO, negative divergence, and now we have struggle just looking at the 10-year Treasury yield. So if we can't continue to make that move to the upside, if we don't, we were in that nice uptrend for a while, and then we consolidated between 150 and 175, but we did manage to close just below that 150 level on Wednesday. If we can't strengthen off of this and make that a false breakdown, I think financials could be in trouble in the near term. Materials, on the other hand, sideways consolidating. I think this group still looks okay, although on a relative basis, it has been outperforming or underperforming. And we do see here, if you go back to these recent lows around 85.5 or so, that should be an area that holds as support. So that's something I'd keep an eye on. All right, let's move on. I want to talk about the 10-year Treasury yield a little bit here. So we finished at 1.49%. Now, I've been talking about 150 to 175 as a key area of yield support and consolidation. This is where I expected that we would see the yield consolidate before we actually made a breakout back to the upside. And I was expecting that because from an economic perspective, we've seen a lot of strength in the market. We've seen the GDP posting its highest level in many, many years. And so I thought that we would see the 10-year Treasury yield break out and move closer to that 2% level, maybe 1.9. But these last few days, as we've been heading toward this inflation data, we've seen yields dropping, which is somewhat perplexing, to be honest. I would have expected to see the yield moving higher into these inflationary reports, but we've been seeing the opposite. And I pay attention to what's on the charts. So we're going to get two very critical inflation reports out over the next few days. On Thursday, we have the May CPI report. And then next Tuesday, June 15th, we have the May PPI report. And of course, the Fed will be meeting right on the heels of that Tuesday and Wednesday of next week. I've been looking more for sideways consolidation, maybe with a little bit of bias to the upside. That is not taking place right now. As you can see, the last few days, 10-year Treasury yield lower. I think we've got to at least acknowledge the fact that perhaps the 10-year Treasury yield has topped near term. Maybe we're going to roll over. I would be surprised if we went much lower. But any kind of move to the downside or even sideways consolidation as opposed to a breakout, I think would benefit growth stocks. And we've been seeing those growth stocks outperforming value stocks over the last 30 days, which is a little bit of a, I don't know, maybe a little bit of a shock. I don't know if shock's the right word, but certainly a surprise. As we look forward, going through the next couple of weeks, I think the way the market reacts to this inflation data is going to give us some really big clues as to the market and where it's heading going forward and what's going to be leading the market, which I think is really critical. So looking at the 10-year Treasury yield, I am surprised we closed below 150. We have initial jobless claims out in morning on Thursday. The estimate 369,000. Last week 385,000. So we're actually continuing to drop in terms of those initial jobless claims. And as I mentioned, Thursday, May CPI and core CPI will be out, and we're expecting 0.4% rise. Keep an eye on that because this data, the May 2021 data, is replacing the May 2020 data in which we saw a drop in the CPI. It was the third of 3 consecutive drops, March, April, and May. So the fact that we're getting this, behind us, this is absolutely setting up for a very big headline inflation number on Thursday morning. I think that we're going to see numbers that we haven't seen in a couple of decades, maybe going back even further than that. And we'll see how the market reacts to it. I think that's going to be probably one of the biggest takeaways this week. It's not whether we see inflationary data that's high, because we're going to. The question is, how does the market react to it? And that's the thing you want to focus on. All right, let's keep moving on here. The IWF IWD. This is the iShares Russell 1000 Growth ETF versus the iShares Russell 1000 Value. And if you look at it since all the way back in September of last year, we have been downtrending. So growth stocks have been out of favor relative to value. I believe this is going to change. Now, is it going to change with this double bottom coming in at 155, which tested the low back in June? Or do we make one more breakdown? I think it's right now, I think it's a very difficult call to make. I think once we get the inflation data out, we get the next Fed meeting under our belt, then I think we can start to look and see how the market is reacting to all this, and then be able to make a more definitive call, I think, on whether or not the market has bottomed, whether or not growth stocks have bottomed. But for now, I think we just have to sit back and wait and see the market's reaction to this. Another relative ratio that I'm following and continue to follow is the XLY versus the XLP. That's, excuse me, discretionary versus staples. And if you look back over the last, I don't know, 14, 15 months, you can see that this ratio, which had dropped all the way back down to 1.6% or 1.6, excuse me, 1.6 during the pandemic has now moved back up. And after topping around 2.6 in February, has pulled back and consolidated. I don't have a problem with this consolidation on a relative basis. What we want to see as the S&P 500 keeps moving higher is we want to see that relative strength in consumer discretionary versus consumer staples. And I think overall we've seen that. We saw back at the beginning of the year, new highs being set. We've pulled back. I think we continue to consolidate, but I think the overall trend is to the upside, and I think that's very bullish. One other relative chart that I like to follow, that's transports versus utilities. When the market's in a really good mood, you should see transports performing well while the defensive utilities kind of take a back seat. And that's what we've been seeing over the course of the last 14, 15 months. We've seen transports significantly outperforming utilities and breaking to a new high, taking out the 2018 highs. So I think all of this is very bullish. The long-term picture, I believe, continues to set up for higher prices. The only question I have is in the short term, as we go through these summer months, which can be very difficult from time to time, do we make a new high or do we need to pull back for a period of time? I don't have the answer. I think the market's going to give us that answer here over the next week or two. All right, let's move on to break it down. So what I wanted to do here is, first of all, let's just take a look at the last week. You can see the best performing sector has been healthcare. Now, in our, we send out a lot of information to our members throughout the month and on a regular basis throughout the day in our daily market report. But back at the beginning of the month, we looked at, we published our June short report looking at a number of the stocks that had really high short interest. And we noticed that 18 of the 42 highest short percentage of float stocks were in the healthcare area. 18 out of 42. It's pretty significant. 40% of the highest shorted stocks are in the healthcare area. Well, healthcare, you can see so far doing particularly well. And as a result, many of these healthcare stocks are doing well as a result of some of them starting perhaps what it looks to me anyway to be short squeezes. If we take a look at the XLV on a seasonality standpoint or from a seasonality standpoint, and we compare that to the S&P 500, I want you to take a look at June. Over the last 20 years, June has been the best month for healthcare in terms of outperforming the S&P 500. 70% of the time, we have seen healthcare outperform the S&P 500 during the month of June. And if you look at the outperformance, the average outperformance down here at the bottom, there's only 1 month that is done better than June, and that's been January over the past 2 decades. So this is the month when we tend to see healthcare do really well. And I think that's really important because if we go on to this next chart here, actually, I think I had one other. Well, I want to just go through and show you from a relative basis how these various healthcare industry groups are performing relative to the S&P 500. So first, let me just point out that the Healthcare Providers Index, which in May had set a new, it was about an 11-month relative high versus the S&P 500. We've pulled back here over the past couple of weeks, but this is a group that I would watch very closely as we go forward. Medical equipment had been under a lot of pressure on a relative basis and trending lower, but we've had a nice start to the month of June. Keep an eye on this group. Moving on to pharmas. Pharma's actually bottomed on a relative basis back in April, starting to make a move to the upside. And here in June, they've been very strong on a relative basis. So that's certainly helping healthcare. Then we've got medical supplies. Medical supplies, which had been downtrending on a relative basis, so far to start June, kind of flatlining relative to the S&P 500. So we'll see whether or not we can get some relative strength building there. But one group that I really want you to pay attention to is biotechs. And there are two reasons for it. Number one, we're seeing biotechs move back above on a relative basis, moving back above their 20-week EMA. We have not seen that since back in February, and it's coinciding with a breakout to an all-time high. So biotechs to me look really strong right now. I think I'm trying to think back on our short squeeze chart list. There's 42 stocks that have short percentage of float above 20%. 42 stocks. 11 of them are in biotechs. So think about that for a second. 11 of the 42 highest shorted stocks are in biotechs, and biotechs are just breaking out. That tells me we want to at least be considering these stocks that are heavily shorted for potential short squeezes. So keep that in mind. Now, as we go forward, what do we want to look for? Whether obviously different ways to look for individual stocks. I'm going to just take you back to your dashboard. And then if you go down to Scooter Reports, which is under summary pages down here at the bottom, you can go under large cap stocks and just type in healthcare. And it will bring up in Scooter order some of the best large cap healthcare stocks. And if you want to just make it biotechs, just start to type it in and it will bring up the best performing biotech stocks based on Scooter rank, which is StockCharts technical rank. So all of this, I think, is really important because this gives you an opportunity to identify not only a area of the market that's performing well, but by using the Scooter reports, you can then zero in on individual stocks. Now, this is large caps, but you may have a preference for mid caps or small caps. So switch this to mid caps, biotech, and here are the highest Scooter scores among the mid caps in the biotech area. And then you can switch to small caps and so forth. So just gives you an idea of different ways to approach the market to find individual stocks within key areas of the market that are starting to outperform. That's the whole idea here. All right, let's move on to earnings spotlight. The first stock I want to bring up is GameStop. Now, those of you who have followed the market for a long time know GameStop's one of those meme stocks, been outperforming, been absolutely crazy. This was a stock that I featured back in September right here. And when I wrote about it, it was in early September. And I said at the time, GameStop could be the mother of all short squeezes because of the level of short interest in this stock. And so it was moving up, volume was picking up. Now, when I looked at it when it was $6 or $7, did I think it was going to go to $500? Of course not. I mean, that's crazy. But you do have to recognize the short-term market inefficiencies. And short interest is just one of those areas that points you to the potential of short-term market inefficiencies. So GameStop, which had a tremendous level of short interest, continued pushing higher all the way into January when it went to $500 a share. I thought it was crazy. Then we went from 500 all the way back down to about 30. And then literally a month later, we were back to 300 again. The volatility here in this stock has been amazing. Well, after hours on Wednesday, GameStop reported their earnings. And the stock was expected to lose 67 cents a share. They lost 45 cents. So it was better than expected. But the stock after hours was down 5%, a little over 5%. It was challenging the 300 level, which is where maybe even a little over 300, which is where we had moved back in March. I wouldn't be surprised to see maybe a pullback, test that rising 20-day moving average, and then we'll go from there. But this is a stock that's just made a huge run. I think you just need to be careful with it in the near term. Next up, RH. So this is in the home improvement area. And RH was expected to earn $4.20. They posted $4.89. And so after a huge move up in March and April, we consolidated, and the stock after hours was up almost 7%, taking it up about $40 or so. Now, that's not going to be enough to make a breakout, but I do think it's enough maybe to start this cup right here. So if we can get through 650, which is short-term resistance, I think RH has a good shot to make another run for maybe about 720 or 730, and then we'll see whether or not we can get the breakout. So watch for that from RH on Thursday. Let's do one more, Verint. Then we're going to go through the three you must see pretty quickly. Verint actually beat estimates, 44 cents versus 37. Stock was down fractionally after hours, less than 1%. I don't know where it's going to go. We've got a range here down at the bottom around 44, 43.50, top side 52.5. I just think we're in that trading range for now. All right, moving on to the three you must see. First up, and I just want to point out RMD, look at the volume picking up. This is ResMed. This is in the healthcare area, breaking out above the April high with volume picking up. I think this stock's got a good chance to make a run at that high in January. So watch for that. Next up, Tootsie Roll. This is a stock that's been heavily shorted, but is trying to make a breakout above that March high. If it does, I think this is a stock that could run. Keep an eye on it. Last one, CBOE. This is CBOE Global Markets. It did close at a new high on Wednesday. So I think this is a stock that could break out, make a run for 115. If it gets through 115, I think it's got some blue skies ahead. All right, that's it for me. I appreciate everybody tuning in. Thanks so much for your support. I will be back next week starting on Monday for the next Trading Places live webinar. That'll be over at earningsbeats.com. I hope you can join me there. Everybody take care. Have a great Thursday. Enjoy your weekend. Watch for those inflation reports. And I'll be back next week. Take care, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.